And now, I'd like to introduce today's presenters. Jamit Arora, partner, leads Everest Group's researching offerings focused on enterprise executives in IT, sourcing and vendor management, and shared services. Michael Jensen, Chief Research Officer, guides the practice's research agenda and architecture by leveraging his extensive experience to identify and unlock emerging trends. And David Ricard, Vice President, leads Everest Group sourcing and vendor management and customer experience management services offerings from EMEA clients as well as select global accounts. And with that, I'd like to turn things over to Michael.
Hello, everybody. So exciting times in our industry. Business is booming. If you've been watching the earnings reports come in on Q2, they've been fantastic. Wall Street's loving it, hitting new all-time highs on stock markets around the world. Having said that, that doesn't mean that there are not some challenges that we're all looking at, and we're going to be talking about some of those. Talent is a constraint that we're seeing right now. Actually, the business is booming so much that finding enough supply of talent to meet demand is actually one of probably our biggest challenges for the industry. We're seeing inflationary noises, and we'll be talking about those as those are manifesting in two different ways: rising salaries, rising rates that we're starting to hear in the industry. So we're going to delve into both the good and the upcoming challenges that we see maybe, and we'll take it from there. So let's get started on that, and we're going to talk about the state of the outsourcing. We're going to talk about strategies for spend management, and then we'll get into some Q&A. So if you have questions, feel free to insert them into the chat window or to the Q&A window, and we'll address those along the way if we have time, or we'll certainly try to get to them at the end. So let's drop into some the first set of numbers here. And when I talked about businesses booming, probably the easiest way to do from looking at the major players in the outsourcing marketplace. And so you can obviously see the dip that we had when COVID hit and we went into lockdowns around the world. And what you're seeing on the right side, the far right, in terms of some of the early numbers for Q2 here is an accelerating revenue stream for major consulting and applications providers in the industry. So the combination of BPO and IT. And so pretty exciting to see the numbers to return to where they were and actually above that. And so we're going to also look at some other metrics here. Jamit, you're going to talk about the utilization rates.
Yeah, and hello everyone. So as you can see, right, with the sharp recovery that we've seen in the landscape, there's also a pretty significant increase in the utilization. And what this is effectively measuring of the people I have as a company, what percentage of these resources are fully staffed on projects, right? Now, different companies have different ways to measure utilization, but I think if you will look at this slide from where we were, even pre-pandemic, right, the numbers are significantly higher and suggesting that some of the supply constraints that we're talking about are here for a while because most of the supply market is seeing high levels of utilization.
So Jamit, when you start to look at this is the utilization, but I know you and I have been talking about another aspect of this, which is attrition.
Yeah.
What are we hearing and seeing about attrition?
Yeah, attrition creates a double whammy from a supply perspective, right? So we've seen some pretty significant upsurge in attrition. In some ways, the V-shaped recovery chart you had on the previous page, which was showing growth, we are seeing something similar. There's more distribution there. So on the IT services side, for example, you see attrition between 20 to 30% voluntary attrition for some of the players, right? Which means 1 out of 4 or 1 out of 3 people in your team is seeing churn. If you look at call centers, right, and this is where the situation is a bit different by geography. In the US markets, we're seeing reports of, annualized attrition as much as 100% in some geographies, right? Which means pretty much your entire staff is churning over a period of 12 months. So high utilization combined with high attrition creates some very interesting supply dynamics if you're in the sourcing industry.
Yeah, that kind of sets the tone here. Really, really active business climate. But once you start down the attrition path, attrition creates more attrition, and then you have a set of reactions that have to respond. The businesses have to respond to slow that back down again. So, all right, well, David, get us into the some of the aspects of talent shortage that we're seeing here.
Yeah, thanks, Michael. Yeah, and just picking up on Jimit's point there, really. I mean, what we're seeing when we talk to enterprises is that 86% of enterprises are saying that a talent shortage is going to impact their ability to deliver their outcomes. So that's really a startling number, really, in terms of businesses not being able to hit their objectives because there's a shortage in talent. There's a couple of things along the bottom you can see there that are really driving at, but the couple that jump out for me. First, the existing workforce lacking the technical skills that they need. And I think that's sort of, obviously there's a fast moving pace now. Digital's really caught fire. Everyone's looking for those digital skills, and the existing workforce just don't have the skills that they're needing to make their digital objectives come true. And you just can't train people quick enough to get them up to speed to be able to do that. And then following on from that, there's obviously the attrition issue that you mentioned earlier. But as those skills are becoming really hard to get, then obviously people are jumping for better pay or what they perceive to be a better role. So attrition is really driving that as well. And that also means there's less people on the market looking for jobs. So all those things are combining and meaning they are putting at risk some of the projects that enterprises are going after. And I think that Jim is going to cover in the next slide, just covering some of those roles where we're seeing the biggest crush in terms of talent.
Yeah, and you know, it's David, the point you mentioned about how companies are using this as an opportunity to advance their digital agendas. The three top areas where we are seeing significant increase in the number of job postings is related to cloud, data and AI, and cybersecurity, right? Again, all of these are in response to an overwhelming desire on the part of companies to accelerate their digital charters, right? So that's kind of the whole demand surge that we've spoken about previously. What's then kind of constraining supply here is the fact that we've got travel restrictions, and some of you might wonder, okay, if there's travel restrictions, how does that make things weird? But it's essentially from an IT standpoint, you know, the onshore markets have relied heavily on the suppliers from India sending people on visas. That's constrained availability. As an offset, they've said, hey, let's go out and find talent from campuses in the US, in the UK, Germany, etc. But they're finding that the project readiness of this pool is still not adequate. So you've got a bit of a surge in demand, constrained supply, a lot of need for cloud data security, and you've created in some ways the perfect storm to manage the equilibrium of demand and supply.
So Jimit, there, you were speaking about the overall kind of the IT. You mentioned earlier about the call center or the contact center being hit as well, and I think that's actually a different set of challenges there. It's a competitive market with the, let's say, the rising or skyrocketing minimum wage here in the U.S. Creates a different set of dynamics.
Yeah, absolutely right. So it's like every segment in some ways feels like is facing some talent pressures. And as we speak to category specialists, right, that's what they're trying to navigate. What should be our strategy when it comes to IT hiring or IT sourcing? What should be our strategy when it comes to call center sourcing? And as we go along, we'll talk about some of the mitigation steps that we are kind of suggesting to our clients or what we are seeing in the industry. But yeah, it's across the board. We are seeing challenges. The one thing you can take away is all of this is going to further accelerate the demand for digital transformation. Automation requirements are emerging significantly out of the call center challenges right now. You know, so it's been pretty interesting to see how across categories we are seeing the theme play out.
Yeah, and I think the point that we're both trying to make here, we're all trying to make here, is that it's not one issue that we're dealing here. It's a combination of lack of skills, big demand, competition on price in terms of job labor expectations of the pool. So, all right, so let's look at some of the data we just gathered up here. The focusing on how challenging it is to get IT talent. And we broke it into 3 segments: recruiting, hiring, and retaining. So think of recruiting as the way to get applications. Hiring is to get them onto, get them to accept the offer and show up at the front door, or at least virtually. Retaining is keeping them in the house. So you can see here, overwhelming response of more difficult across all 3 different dimensions. So not expect, we didn't expect to see something different here. But this is, a crucial part of the equation, and we'll talk a little bit about some of the levers that people are trying to pull in a few more slides here. So, David, talk to us about the BPS segment.
Yeah, thanks, Michael. Yeah, I mean, at Everest Group, we talk about BPS, business process services, moving into what we call 4.0. And that can sound a bit cheesy, but it's really to show that the industry's moved on. That the BPS 1.0 was when it really started, and it was all about cost arbitrage and sort of labor arbitrage by taking cost out. Then we moved into BPS 2.0, which was much more around efficiency and quality. And before COVID struck, we were in BPS 3.0, which was really where organizations were looking at sort of driving out costs, but also increasing efficiency, improving quality, but also starting to think about the experience through that journey, whether it's customer experience or stakeholder experience or employee experience. But really, when COVID struck, we saw that really accelerated the move into what we're calling BPS 4.0. And that's been driven by sort of what we call there's sort of 5 major factors. Customers are expecting more and are expecting more from the journeys that they're on. Technology is really pushing forward, and there's a real need to drive innovation and disruption. The mix of the workforce is changing. I'll cover that in a bit more. Obviously, the geopolitical environment has changed in terms of protectionism and things like that, the global recession, but then also there's been an increased focus on risk management. So historically, I've been in the industry quite a long time, and business continuity was always important, but I think COVID has really driven that. So as we've moved into BPS 4.0, we are seeing that these factors are also being focused on, but talent shortage is also going to be a factor as we move forward on there. And actually, on the next slide, we talk about some of the short-term talent impacts that we're expecting to see that are going to sort of maybe hamstring BPS 4.0 as it moves forward. And we talked quite a lot about this, but some of the short-term impacts that we're expecting. So we've touched on the talent shortage. Michael's touched on inflation as well, in terms of we're seeing inflation, depending on which country you're in, that's going to have a bigger or smaller impact. But I think shortage of tech skills is going to be a really important factor here, because I think that as all organizations, and you saw from my previous slide where we said 86% of enterprises are expecting the talent shortage to impact their outcomes, the shortage of the tech skills, not only from an IT talent perspective, but also to be able to deliver some of these digital transformations that enterprises are looking at from a call center perspective, from an F&A perspective, are really going to hamstring some of the progress that we could make there. I think driving attrition, we've touched on. And then lastly, I think lower budgets from a sourcing perspective, what we're seeing is there is big pressure on the business to say we've actually got to cut our costs. So we're trying to deliver all these digital initiatives. We're going to need talent, but also there's a need for lower budgets. So there's lots of things coming together as we look to try and move towards BPS 4.0.
So David, I look at a lot of these things, and these are kind of the 3 to 6 month kind of crisis momentum conversations that need to be addressed, and rightfully so. I mean, you can't run a business if the staff's not there. So you got to really focus on that immediate short term. But what are some of the longer term aspects that you're thinking about?
Yeah, I mean, I think there's 3 main aspects as we cover on the next slide there, really. One is going to be around talent supply, and so where you get the talent from, and how you make sure you've got the right talent for your mix. Talent demand is what I would look at is in terms of, so what are they going to be doing? And we cover this in the next slide in a bit more detail. And then lastly, it's the organizational structure. So how are they going to be organized to deliver this year's future model? So bringing these 3 things together are going to be really important, again, to deliver BPS 4.0 as we look forward. And if we move on to the next slide, we go into a bit more detail about those. But in terms of talent demand, it is really about thinking about, okay, as we look to bring digital transformation from forward, we're going to need these tech skills to be able to bring it. But also, as we're also able to bring or eliminate some of the easier or simpler types of interactions, and actually the demand for skills is going to increase as well. So you're going to need less of the lower skilled workforce, but more of the higher skilled workforce. And they're going to have to bring industry knowledge and sector knowledge as well. So again, you've taken out the simple transactions potentially, especially from a BPS perspective, and they're going to need to bring talent that they maybe not have needed in the past. From a talent supply perspective, then actually you need to look at the size of the talent pool. So actually, I think that the way that people have embraced work from home, using hub and spoke models, will actually give us the ability to maybe look at some of these untapped talent markets that we've looked at. So being able to work outside of some of the major cities actually could be a good thing from a talent supply perspective. But we are going to also have to think from a BPS perspective around niche skills. So again, as you need a more talented workforce, as you're not dealing with the simple transactions, but maybe where you need things like such as problem solving skills or higher levels of empathy or emotional intelligence, how do you bring these niche skills in? And that may be through things such as gig workforce, or really looking to use work from home. And then also looking at how you bring in diversity into the workforce as well. And again, because we've been able to use people working from home, gig would all be maybe enablers in terms of bringing things to the workforce from a diverse perspective. And then the last thing that's not on this slide is around how you organize the teams, and that'd be around the talent pyramid. And as you start looking at, you're going to need less of the tier one, for example, level resources as the simpler interactions have gone. You're going to need more a tier two or management layer, who are then making decisions or able to deal with the more complicated issues as you've simplified the processes. So from a BPS perspective, it's about finding the right talent, it's about having the right skills, and then organizing them in the right way.
So David, let's talk about this talent demand supply equation here. I was doing a session with one of our engineering services teams, and they were talking about a segment that was 8 million or so, and they were 1 million short from that. So, you know, you weren't going to generate an extra 1 million on a pool that size very easily. And essentially you couldn't do it just by, you know, putting up the help wanted sign. I know that you and your team and other Everest teams have been working on this, building out these talent supply demand engagements here. Tell us just a little bit about how those work and why they're important.
Yeah, so I think it's about really, again, understanding what demand you need, and then starting to think about, okay, where are you going to get that talent from, and how do you fulfill that demand? So whether it's from more working at home, whether it's leveraging gig, whether it's actually reevaluating the pyramid to really question, do you need so many at a tier one, and is that a tier two role, or the other way around? How do you balance the pyramid? So it's about looking at your demand, how you need to be matching that demand, and how you can then match that with the sources of talent that you've got. And also thinking outside the box sometimes, in terms of, you've always gone a traditional route of getting your talent, but actually are there other opportunities to get talent from other places? And that's where I think things such as flexible working models or gig are going to sort of open up the door, hub and spoke models as well, to maybe step outside of the traditional places where you've gone and got the labor.
Jimmy, let me ask you a question on that. So the location stuff that some of our teams are doing, how does that play into this conversation? I mean, they're really focusing on that. Where is that supply at?
Yeah, so Michael, if you remember this time last year when we were talking about location strategies, the motto was everything is on the table, right? Right now, from a supply perspective, the location strategy feels more like more of everything. So what people really want to do is they want more in India, they want more nearshore, more in Eastern Europe. And this is being seen as a way to diversify your supply base and create supply chain resilience. At the same time, let's recognize that cost pressures are real. So offshoring in general is expected to increase. So whatever arbitrage we can get, be it in Latin America from North America, be it in Eastern Europe from Europe, or more in India, doubling down in India and Philippines, that seems to be the desire. So if you've got 2 centers already in India, what's my third or fourth? If you've got 1 country in Latin America, what's your second and third? So more of everything is the philosophy when it comes to some new supply decisions being cut off in offshore, nearshore geographies.
Yeah, and I think that's really the again, you can't just expect to put a posting up on a job board and say, hey, they're going to come to me. You're going to have to go to them, and you're going to have to find the sources of that extra 1 million or 2 million or 3 million bodies that you're looking for, because you're not the only one doing it. It's you and your neighbors, and we talked about the attrition. It's going to be a vicious cycle, and you're going to have to, you can raise the ante on the price and steal from your neighbor, but that doesn't work very long. doesn't really solve the problem. So, all right, great. Well, let's move on. David, talk to us a little bit how some of these things are going to get measured.
Yeah, and I think this is an interesting point. So from a procurement or sourcing perspective, and also from an all-up BPS perspective, it's always been looked at really as how do you reduce the cost to serve? And I think that as we expect to move into BPS 4.0 and start thinking about business process services being a key business enabler moving forward, I think the good news is that we're going to move away from just looking at cost to serve to start looking at some of the other key important factors that I know procurement and sourcing professionals have always seen as really important, but maybe their main sort of measurement may have been cost to serve. But we're starting to think about things such as stakeholder experience. So how are you serving the business, not just are you saving money? Starting to think about that sort of the business outcomes achieved. So are we achieving the business outcomes again, not just doing it at the lowest cost? I mean, the direct cost to serve and the dollar benefits are always going to be there. That's just the nature of procurement and sourcing. But I think the good thing is that we're starting to think much more about stakeholder experience and business outcomes. And I think that what we talk about in the slide, we actually expect, or service providers are expecting, 100% of them are expecting instances of outcome-based pricing, and 1/3 of them are expecting it to increase significantly. So moving from the cost per transaction or cost per FTE to true outcome-based models, which I know has been talked about in the industry for 15, 20 years and have probably never really got there. But I think that now there's much more appetite on both sides to really start thinking about let's pay based on the outcome versus just trying to reduce the cost to serve. And this is only going to get more important as we start weighing in the talent impact as well. And it needs to be, how do you derive an outcome versus just paying per FTE if there's shortage? How do you drive transformation? And digital transformation has to be paid for more by outcomes and just paid for cost per FTE, for example. So good news, I think, from a procurement perspective or sourcing perspective.
All right, great. Jamit, this has been a rapid change in the marketplace. The conversations we were having just a quarter ago have changed significantly. Talk to us about that kind of U-turn in the marketplace.
Yeah, I think we had a slide on that as well subsequently. So you want to do that when we get there?
Yeah, there we are.
Yeah, perfect. So yeah, I mean, it's a complete U-turn that we've seen, right? And that's why this becomes really interesting. Wherein back in April, we were talking about a situation where we were seeing price contraction. Clients were getting rebates. Now we are talking about price expansions, right? Deals that were negotiated back then. If you memorialize them, great. If not, suppliers are saying, hey, can we renegotiate these prices before we sign them? There was a lot of demand uncertainty, and now there's a complete surge. People were thinking about consolidating their portfolios. Now there's talk about diversification. I want to be mindful of that, because I think where and what strategy you deploy should be a function of the kind of work. So is it run work versus build work? But in general, we've seen a shift in that direction. It used to be an employer's market. It's absolutely an employee's market right now. So if you just look around some of the things being offered, and this is some examples coming out of India, startups are offering people BMW motorcycles as sign-on bonuses. iPhones are being given away, right? So it is getting a bit crazy. So it's very much an employee's market. From a procurement perspective, a number of you I've spoken to in the past, have said, hey, this is very much a buyer's market. This is no longer a buyer's market. I wouldn't go as far to say it's a seller's market either. It's actually truly an employee's market. So they are going to dictate what's going to happen. But definitely as procurement, as sourcing professionals, we are seeing that our negotiations leverage has definitely come down. So complete rapid U-turn in the last 3 months. Who said procurement and sourcing is boring?
Exactly. All right.
And therefore, what has that done to the economics, right? And again, we like to think of patterns, and as we've been doing some pattern recognition, pre-COVID, general economic pressures, Q1 of last year, just before all the lockdowns started to happen, there were signs of a weakening global economy. Rates were staying the same. Clients were starting to make some noises about, hey, let's find ways to cut budgets. The Q2 to Q4 period, right? This is where I'd say if you were in procurement, you negotiated great deals for your company, right? We saw some very significant savings that people were able to achieve, both in terms of realigning rate cards as well as getting one-off rebates for their budget pressures, right? The suppliers kind of really came through and companies were able to renegotiate rates, and we saw 4 to 6% on average reduction in rate cards. Beginning of this year, the first quarter of 2021, there was vaccine hope. Michael, you were talking about pent-up optimism. In some ways, rates stabilized, right? There were fewer deals where the service providers were able to say, hey, we're going to entertain a significant rate reduction. And if you look at what's happened in Q2, if you look at what's happening right now, suppliers are testing with their clients, how do we get potentially higher rate cards, right? So we've been on several calls over the last few weeks where, the theme has been 5 to 10% rate increases to, in some cases for call center, more than 50% rate increases, right? Obviously, there's resistance to that. But in some segments, there also has to be a bit more of a pragmatic stand where the supply constraints are so real that unless there is a bit of a compromise, we will find quality suffer, milestones being missed, customers not being serviced. So I think we're kind of entering a different era of rate renegotiations.
So Jamid, you and I are having a conversation recently where somebody said, I had renegotiated at the end of 2020, so I'm good, right?
Technically. Yeah, I mean, it's like, again, everything is on the table when it comes to the rates again, right? Some of this will be a function of what's the strategic nature of that partnership. And if you truly see this as a partnership, what you don't want is, you don't want to be so locked into your contract that you just start to see that the suppliers are going to provide very poor quality resources. And we're seeing some of that right now. Go back to the thesis, if you're working with a supplier that has 30% attrition and you're going to hold them to those rates, you're probably going to get the trainees that they bring into their life cycle. So yes, legally, you're okay. Reality is going to be a bit different.
So let's talk about the sentiment because, like I said, this is real time. You're sensing a change, a pivot point in a marketplace. We did a CPO roundtable, I think it was just last week. And in that conversation, about half of them had been approached and the other half were starting to prepare to be approached. And so I think that's kind of where we're at right now. I expect that to change, in Q3 to see, the dynamics continue to move. I can't see it. Something has to change in the supply demand conversation.
Yeah, no, I think there's a couple of questions, right? One question is, what should be our outlook for the rest of the year when it comes to pricing, right? And obviously, there is no one single answer because it varies by category and it varies by geography. But if you look at the situation, the two biggest sectors that you would see, there's the whole call center space, which is seeing a lot of churn and change. Call center also includes some of the adjacent areas, right? So for companies in technology, there's things like content moderation. Those areas are seeing pressures. And then if you see IT, I'd say that's a bit more universal, a bit more global, right? Moving away from the sentiment, we tried to do a forecast in terms of how the pricing's expected to evolve. And when it comes to onshore IT applications and engineering services, you can see that after that dip in H2 of 2020, we now expect to see a pretty sharp recovery in rates going forward, right? In fact, the conversation for us, we do a lot of pricing analytics, a lot of price benchmark. The conversation for us has shifted away from, hey, let's make sure we have the right rates to save money. Let's make sure we have the right rates to get the resources at speed that we want so that we aren't underpaying versus market, right? So a lot of work happening in that area. In general, onshore pricing will see more pressure than offshore pricing. And that is again becoming one of the structural drivers why people are looking to more offshore as part of one of the solutions to the pandemic.
Yeah, and I think that's the key there is India Inc. has been especially good at bringing on lots and lots of talent at scale.
Yeah.
You know, it doesn't happen in a 1 quarter time frame, but if you look at the ability to hire lots and lots of, I'm not talking about millions of resources, not just, you know, tens of thousands, but I'm talking about millions of resources. That's probably the mitigating factor to all of this. I mean, you could go through we could do an economic recession that would maybe make a U-turn here back the other way, but India Inc. is probably the largest mitigating factor here. So let's get a read from you guys, the people on the session here. What are you seeing? Let's do open up the poll lines here and get a sense of. I don't think it's really select all that apply, but really get a sense of your services cost have increased. You're being approached. No cost has been brought up yet, and we're not sure yet. So go ahead and let's see what you guys are thinking. Okay, we'll leave it open for another 2 or 3 seconds here. 5, 4, 3, 2, 1. All right, so okay, so this is interesting. So over half of the participants in this webinar have had a request, and 40% of you have seen an increase already. So so Jimit, this is really changing fast here. It looks like only roughly 20% haven't had this conversation in the marketplace.
Yeah, and again, you know, as I said, this is broad-based, but if you're just in, say, finance and accounting, running a very stable environment, this may not apply to you, right? So there's some categories where the issues are more pronounced versus others, but that is the direction of travel for the industry over the next couple of quarters.
Okay. All right, good. It's good to get input right along the way here. And again, real-time shifts in the marketplace. All right, so let's talk about the strategies for spend management. We just did a poll in the marketplace. In fact, we're just distributing this now and just using with our teams here. But we asked the question of what are the mitigating levers that you're using as an organization to drive the talent acquisition and retention here. And really, you can think about this in 3 broad groups. So hiring pool expansion, some of the things that Jimit and I have been talking about, you know, it's not, you know, if you look across the street, yes, that'll work for some things. But if you really want to think about this, it's really about expanding the channels. So looking into different options, not just employee models, but other third-party models, and then allowing flexibility in location. So moving the work from home as part of that conversation, but also looking at deeper global talent pools. Those were the 1-2 options in this conversation. The second aspect of this here was really around the process, improving the hire process. I'll make my commentary that I put in the slide there, which is never hurts to have good hiring practices. I don't think it's going to be the swing vote that actually makes a difference, but I think it's people are trying to pull that lever to improve, streamline the process. Certainly the group of 3 there in the compensation category, certainly money talks. And at least in the short term, that's probably the lever that's easiest to pull, whether it's retention of counter offers, customize the benefits. I think at the end of the day, yes, money is important. Some of the benefits may be cheaper to attract people. I don't know if I'm looking for a BMW motorcycle, Jimit, but you know, if you had some things that were to allow other aspects of quality of life, I think that will be a deciding vote that goes beyond the monthly or weekly paycheck. So any other thoughts there, Jimit?
No, I think there's one question that keeps coming up, which is, you know, and if you step back and think about this, all of this is suggesting your budgets for 2021 are going to get blown, right? Let's face it. So what companies are now wrestling with is, hey, if you mean compensation, what should we do with compensation from a budgetary standpoint? And the one strategy that most people are trying to adopt is to not fundamentally change the operating baseline. So not look at it from an OPEX only perspective. So don't do something indiscriminate in terms of, hey, let's go change out all our rate cards, or let's go change out all our operating, our salary structures. Let's do bonuses which are more one-time in nature. So joining bonuses have become really popular. Retention bonuses have become really popular, but there is no need for you to replicate them year on year because people are hoping that this situation will ease up as we enter the next year. So it's a fine balance between what's OPEX versus CAPEX. Companies are trying to deploy more CAPEX-oriented structures, even as they move towards the compensation changes.
Yeah, I think that's I mean, it doesn't solve the structural issues, but it allows you to play in the short term here and retain the folks. All right, so let's look at the, we asked a separate question, but in a slightly different way. How are you trying to address it? And this was really kind of focusing on the balance between compensation, location, and third-party engagement. And compensation as a whole was the #1 choice. But when you look at it very specific to which dimension of all those was the most popular, and it was really expanding the use of offshore centers. So again, keep going back to the conversation. You need to go where the bodies are going to be most likely attainable. And so this looks like it still continues to be a boon, and the combination of rising prices and on onshore and the need to find quantities of resources. All right, Jimit, so let's talk about what our recommendations for 2021, how that's changed from the 2020 perspective.
Yeah, I think, and this is one which I always preface by, stuff that no sourcing or procurement person wants to hear, but some of the tactical negotiation is no longer available. So some of you will recall when we met in for our quarterly check-ins, we were saying in December of last year, we were saying the window of opportunity is closing. In Jan-Feb, we started saying the window of opportunity is closing rapidly. I can now declare that the window of opportunity to negotiate with suppliers is closed, right? You're doing reverse negotiations right now.
Yeah.
So all of the short-term fee reduction tactics, right? Let's get invoice discounts, let's get COVID rebates, let's get funding for digital transformation, let's defer COLA, payment term extensions, all of those things that we could do last year, which were short-term tactics, no longer available, right? What is available to us, of course, is structural changes. And that's where I think the focus needs to be as we think about the remainder of this year and next year. So most companies that have got large portfolios will find that when they go out and audit, there's a pretty significant pyramid bloat that they have in their system, right? So one of the key tactics that people are using when they are getting this request for a fee increase or a rate increase is to say, hey, let's go out and first audit and see whether I'm actually paying for the services that we are consuming. Am I being charged for the right resources? Is my pyramid aligned with market? It's also kind of causing a shift towards managed services. David mentioned how all of the changes in BPS 4.0 are moving us towards digital transformation. So people are trying to do more automation to essentially impact the volume or the Q in the P times Q equation, right? P is going to be very hard to adjust, right, Michael? So it's the Q in the P times Q equation that you're addressing to lower your spend. Not to say spend cannot be addressed. Where you address it has to fundamentally change.
Yeah, P times Q being price times quantity. That's essentially what your invoice looks like every month. And Jamit's exactly right. The time for P is probably done. The better focus right now is going to be on that Q, which is actually structurally more sound over the long term anyway.
Yeah. That said, this would not be the environment to do a 3-year contract, right? Do 1-year contracts. If you have to do a longer term contract, make sure you're putting in clauses which allow you to reevaluate the price, right? But fundamentally, we're seeing sourcing teams push more towards more automation, more structural change, more onshore, more offshoring, etc.
Okay, so let's not get caught up too much in the hype about salary increases. We are hearing about 20, individual salaries being walking across the street for 20, 50%, even more. but that doesn't necessarily translate into rate expectations or rate change requirements here. Help us with the equation there, Jamit.
Yeah, and this is fascinating, and this was in some ways a client came to us recently saying that they were getting, for some BPO services, a pretty significant ask from their suppliers, upwards of 50%. There was a request, hey, my rates need to go up by 50% on a price per call. We're like, okay, that should not happen. And the effective situation is, if you look at the cost profile for these services, yes, wages are going up, but wages only represent roughly 55 to 60% of the total cost profile, right? And recognize this doesn't even include the margin for the suppliers. So if the wages are increasing, and we ran different scenarios and said the wages could be increasing from 2.5 to 15%, depending on where things are. But even if wages are increasing by 15% in some markets, that does not and should not translate into a 15% increase in price. In fact, if you apply this pyramid, the impact on operating costs should be 8 to 9%. Look at the other dimension, 15 to 19% is real estate and facilities. Guess the direction of travel on that component. It's actually coming down, right? We've seen contracts where for the next 3 years, assumptions of work from home are anything between 40 to 60% at steady state, right? So in that situation, you've got wages going up, at the same time, real estate and facilities coming down. So what you really need to do is do the translation to figure out if there is indeed wage pressures, how does that impact the overall operating cost profile for your category? And therefore, what should be the estimate from a price perspective, which then gets you to a conversation about, do you want to increase it? If so, what's the right amount? But let's not get carried away by the hype that, hey, wages are going up 15%, 20%, so prices have to go up that way. That would not be the right thing to do.
Yeah, and I think it's just about being educated. So let's talk about one of the, so I'm an old timer in this conversation, and I remember when inflation was, equal to what it is now, or even a little higher, and we were doing deals back then, and COLA, cost of living adjustments, was a key negotiating factor in those deals. If you think about the context here that Jamit and I've been describing here, and along with David here, it's a typical inflation has been in the 1.5% to 3%. India's been 4 to 8. Forex has actually been, if it's onshore, it doesn't make a difference. But if it's been depreciating, the Indian rupee has actually worked to the buyer's advantage. The net impact has always been very slight. Okay, but if we're starting to talk about an inflationary market here that's 5+% here, maybe it's transitory, maybe it's not. Hard to say. Of course, the government wants to think it's going to be transitory. Offshore is going to be 4 to 8%, and they may see a bump up here as they get into their recovery as well. Forex actually has been seeing an appreciating Indian rupee. Let's call it flat, but it's not as helpful as it was in the past. Let's say it that way. Both those things are going to be inflationary and inflationary. So think about this is if you flip to the next button there, what we see is in the current environment here, COLA clauses in outsourcing contracts have largely disappeared. Okay, the thought was we didn't really need them if we don't really have an environment where inflation's a problem. Okay, especially if it's shorter term agreements. If you're going, the easiest way to mitigate this is not to have long-term agreements. I mean, if the future is so uncertain that both buyer and supplier can't agree to what the future is going to look like, you maybe just need to do short term. But if there's going to be an attempt to do a longer term conversations, you're going to find the COLA clauses coming back. COLA clauses are not perfect. COLA clauses are an attempt to mitigate the major indexing elements of a relation of the macroeconomics into your relationship. So I personally think that COLA clauses will come back in vogue again. There'll be attempts to index to inflation, to foreign exchange rates, and that's a good thing, at least as a conversation piece. Okay, but I think in the longer term, you're still going to have to do benchmarks or some kind of mark to market aspects of it to make sure that everybody's getting a reasonably fair deal. You just can't expect to do. I think the message here is you can't expect to do a deal today and have it locked in for the next 5 years.
Yeah. Yeah, and with that, in some ways, what we wanted to do is to think about what your sourcing strategy on a page might look like, right? And I mentioned earlier, you need different approaches for different parts of the business, right? And I think this becomes really important because it's not going to be a one-size-fits-all approach. So one of the ways, and I know that there's imperfections within this, is to think of the world differently between what's the run side of the operations versus what's the build side of the operations or the change side. If you think of run, that's where you drive towards the savings. That's where you're looking to drive as much digital intervention or hyperautomation. That's where you want high degree of standardization in your operating profile. On the change side, this is where you want to create speed, create productivity. And that's where there's a lot of focus on right scaling, rescaling, multi-scaling as you think of IT, right? So the value props are totally different, and therefore the supply models that you design also have to be very different here. So on run, people are getting more outsourcing reliant, pushing towards managed services, concentrating that portfolio to 1, 2, 3 suppliers, very aggressive in offshore and looking to manage outcomes. On the build side, there's a desire to become more employee reliant, so more internal hiring, more staff augmentation, portfolio diversification, more desire to do local or nearshore, and the objective function there is that you're managing talent, right? So one of the things that we've really been advocating to our clients along this journey is, let's not take blanket decisions. Even within a category, you're going to find different run versus build attributes. And the supply model choices you make have to be different across those. So if we try to unpack that using a couple of examples, right? From a sourcing level standpoint on the next slide, one of the things you see is we said, okay, you want to try more nearshore leverage. Michael, you asked me about that. Significant amount of activity right now in ramping up nearshore delivery. A lot of activity in staffing, relationships with local or niche providers, right? And a lot of the focus tends to be on product engineering, full stack engineers, cloud, etc., right? And it's because of that we've seen that even from a new center setup, nearshore markets have gone up significantly. So more offshore, more nearshore is one way to meet the talent requirements while getting some TCO benefits, right? And from a supply rate card standpoint, yes, you have to be pragmatic. So be prepared for some off-cycle rate card reversals, but it has to be for the right talent, right? And this is where that quote from one of our clients is there that, hey, during COVID, we pushed our suppliers too hard. We got really effective. And then for some of the resources, there is a desire right now to calibrate and adjust rate cards. Yes, you'll be able to recover it downstream. There are other levers, more structural in nature to get that TCO down, but it's not just a rate game that we need to remember. So from structural standpoints, right, what are some of the other things to go after? Bottom heavy team pyramids, right? So one of the things we are seeing is people are questioning, hey, do I really need that super senior specialist? Does everything have to have a senior associated with it? Senior project manager, senior developer, senior tester. Do we need those, right? And that's where people are going back to their counterparts and saying, can we right skill these, right? And in a lot of these situations, if you think about attrition, you might have someone who's called a senior programmer or a senior tester, but in reality is going to function like a programmer or a tester. So how do we make our pyramids more bottom heavy? That's a lever to drive TCO. How do we really remove some of the onshore governance layers? So, that becomes a good lever to reduce costs. Automation, that's going to be a structural intervention that people are going after. And then fundamentally, we've been on this journey towards higher offshore. It increased from 75 to 80% in some organizations, 85 to 90 in some organizations. And, in other situations, especially around managed services, as high as 95%, right? And this is not just an offshore play, it's also a nearshore play. So couldn't underscore that, yes, people have thought about same time zone delivery, but if you look across the cost profile between a US tier 2 city versus, say, Costa Rica, Mexico, Colombia, there's still arbitrage to be achieved. So all's not lost. There's still a number of levers that are available to you all as you think about the approaches to bring costs down. So I know we unpacked a fair bit. David, do you want to bring us home in terms of what are some of the things people need to factor in for the next normal?
Yeah, sure. Thanks, Jimmy. Yeah, I think there's three things that as a sourcing professional, procurement professional, that you'd want to sort of be really thinking about here in terms of the success factors for moving forward. First one is really important, is to start thinking about what is the value that you're bringing to the business beyond just that cost savings. So stepping out of it's all about the cost, as we talked about earlier, but is it really going to enable a customer facing digital project? Is that where the company's going? Are you going to enable a business objective? So really start thinking and being able to articulate to the wider business the value that that activity is going to bring beyond just, I'm going to get it at the cheapest price, is going to be important. I think secondly, it's about getting ahead of the blame game. So starting to warm senior executives up to the fact that the market is changing. Everything that we've covered today, talk about the fact how the market is changing and the fact that there are going to have to be potentially some rate increases to ensure that you get the right talent. But you can explain that by then going back to the first point I made, which is, but we need this talent. We're going to have to invest to actually achieve these business objectives. So you tie the two together. You've got clear objectives for the business that you're going to help enable. You're warning the business that there may be some increasing costs that are going to have to be done to achieve that, but in the longer term, there's benefits. And then the last thing is around starting to think about and dusting off those total cost of ownership models. So starting to, again, be able to articulate, it's not just a rate reduction on a like-for-like basis, but the total cost of ownership through the increased efficiency, the adjusted pyramids that you make by being able to enable a business objective, which then drives growth for the business. They're all things that are going to be really important as you start to think forward. So looking at it holistically, thinking about how you can really deliver the value to the business, not just cost savings, and actually making sure you're communicating it. I think they're going to be really important factors that procurement and sourcing professionals are talking about as we move forward in the next few months and the coming year.
All right, thank you, David. Thank you, Jamit. So let's do this. One of the best ways to get a sense of Everest Group, if you're not familiar with this, is to get a bit more of a detailed taste of what we can deliver. And so what we're going to do is open up a quick poll here for enterprises if they're interested in learning more about. We have three options here: more about service provider snapshots. So we've got a variety of service providers on there that if you're interested in having a drill down on a specific service provider. Option two is a location spotlight. So we've highlighted a couple locations there to choose from. And then, or if the third option is the state of the market report. So if you're interested in any of those, click the link and we'll be in touch to get a complimentary analysis of more detailed market intelligence. And so it's a good opportunity to either meet with David, myself, Jamit, or Amy. Amy's not on the call today, but for the drill down on a specific topic that's of interest to you. Okay, so let's go ahead and close that out here. And then, Jamit, what I'm going to do is ask you to speak about how you helping clients. If you could do that in 60 seconds, that'd be great. And then we'll go to Q&A.
And I think see a lot of familiar faces or names in the window. So a primary motion is to serve clients through memberships, right? We've got for procurement professionals, we've got outsourcing excellence, which is our market intelligence, offering a lot of the analyst excerpts that Michael mentioned come from that. Then, of course, there's pricing analytics as a service, right, which is our ongoing on-demand price benchmarking. And then, of course, there's a variety of projects that we also help our clients with. So want to make sure we leave a few minutes for questions.
All right. So Jamit, here's or David or Jamit, how do you leverage cost and mitigate risk on an environment that is shifting towards portfolio diversification? So it's kind of a back to the everything is on the table. Risk is a part of the equation. How do we put that in the cost equation? Those are kind of a multi-dimensional challenge.
No, I agree. And at the broadest level, I would still say that let's not think about this as a single strategy, right? The run versus change. Michael, I know I added that slide during the webinar at runtime. I think that's a very important nuance as I saw this question, right? Because what it tells us is that we are going to go down the route of portfolio diversification only in a handful of areas which are really critical to change the business. What we don't want is to go back to the world of wild, wild west, where every business unit is going to go out and add their own supplier and create more risk in the portfolio, blow up the business case. So as a central function, part of what we really want to do is have very tight controls over what has to be locked down and further consolidated, and the handful of areas where you will allow portfolio diversification to happen, right? Otherwise, yes, the risk profile will go up and the TCO will blow up. So being very selective is going to be truly important.
All right, here's another real-time question, and I'm actually I'm curious on the answer here because it's changing so fast right now. I don't think we have an answer here, but I'm going to pose it to the team here. Given the current pressure trends, how do attrition rates differ between service providers, delivery locations, and the enterprise global business services? And Jamit, first slide I'm thinking about is a slide that we were talking about yesterday, where we saw that huge difference in the service provider attrition rates. I think it's too soon to say, hey, here's how it's impacting all regions and all different locations and all different practices. I think we're going to really put our ear to the ground and try to quantify that. But any gut reactions there?
Yeah, I'd say in general, gut reaction is GBS centers are doing modestly better at the attrition profile than the service providers, right? Part of it is a business mix issue, right? If it's a GBS for IT only, then I think the attrition rates are higher versus if it's a operation-centric, business process-centric center, right? But in general, what we're seeing is that GBS centers are facing are witnessing lesser attrition. It's increased, but it hasn't gotten to levels of 1 in 4, 1 in 3, right? So I think
that was a shocking number to me. I mean, if the company's reporting that in real time information, first of all, I suspect they're not proud about reporting that. They were loving to report it when it was very low. Now, as it skyrockets, it's going to be a tough metric to explain and to manage.
Yeah.
But the other part I think that you talked about earlier was the call center, the contact center. As the lower end of those salary especially ratchets up significantly, so it moves to closer to the $15 to $20 an hour de facto minimum wage. That is gonna rock this world.
It is.
So, all right, we're out of time. There's a couple more questions here that we did not get to. We will try to get those offline to those that asked those. I want to thank you for your time today. There is plenty of information on our website. There's blogs out there. We are talking about this issue in many different ways. Peter's, love that title there, Acute Talent Set to Break Your Budget. And I think that is, we don't want to put everybody in a panic mode, but we also want to talk about the reality of the Uturn we've seen in the last couple of months here. It's real, it's substantial. And it's too soon to say whether that's going to be a one and done, or is it going to be more, going to repeat several cycles and be multi-year. That's a little too soon to say that right now. So anyway, thank you for your time today, and appreciate your input, David and Jamit.
Thanks, Michael. Thanks, everyone.
Yep, thank you.